Benjamin Franklin said that nothing is certain but death and taxes. Now, in my opinion of the two, taxes are more stressful. So today, since we all don't like taxes, we're going to look at some negative income tax weird on today's episode of 5 Weird Things. Welcome to the channel. I have never been a fan of income tax. There are times I feel like handing my money to a random stranger on the street would be a better use of the money. What's your opinion? Let me know down in the comments. All right, let's get into it. First, the things we should all know. Income tax in the United States is a fundamental component of the nation's taxation system, serving as a primary source of revenue for the federal government and many state governments. It is a tax imposed on the income earned by individuals, businesses, and other entities within the country. Essentially, income tax is a percentage of the income earned by individuals from various sources, including wages, salaries, interest, dividends, capital gains, rental income, and self-employment earnings. For businesses, income tax is typically levied on their net profits after deducting allowable expenses from total revenues. The income tax system operates on a progressive basis, meaning that higher income individuals and businesses are subject to higher tax rates. Understanding the complexities of the income tax system is essential for taxpayers to fulfill their obligations, comply with tax laws, and navigate the various deductions, credits, and exemptions available to minimize their tax liability. Federal and state income tax is due annually on April 15th. Weird thing number 5. Where did income tax come from? Well, the first income tax in the United States was implemented during the Civil War. In 1861, Congress passed the Revenue Act, included a tax on personal incomes to fund the war effort. This initial income tax was levied at a flat rate of 3% on incomes above $800, which is roughly equivalent to $25,000 today. Now, the modern income tax system in the U.S. was established with the ratification of the 16th Amendment of the Constitution in 1913. Before this amendment, income taxes were subject to apportionment among the states based on population, which made it difficult to implement a federal income tax effectively. The 16th Amendment removed this requirement, granting Congress the power to tax incomes without such restrictions. The U.S. income tax system has evolved to embrace the principle of progressive taxation, where higher income individuals are taxed at higher rates. This concept gained significant traction during the progressive era in the 20th century. Initially, the top marginal tax rate was relatively low, but over time, especially during periods of war and economic crisis, top tax rates have fluctuated considerably. For instance, during World War II, top marginal tax rate peaked at 94% for incomes over a certain threshold. Weird thing number 4. States that don't have income tax. Alaska, Florida, Nevada, South Dakota, Texas, Washington, Wyoming, Tennessee, though it taxes interest and dividend income, New Hampshire, though it taxes interest and dividend income, and states without an income tax often rely heavily on other sources of revenue, what they call hidden taxes, such as sales taxes, property taxes, and various fees and licenses. For example, Texas and Florida have relatively high sales tax rates compared to states with an income tax. Now, while the absence of a state income tax can be attractive to residents, especially those with higher incomes, it doesn't necessarily mean lower overall tax burdens. States without income tax may compensate by imposing higher taxes in other areas, such as property taxes or sales taxes, which can affect residents differently depending on their income levels and spending habits. Now, the lack of state income tax can be a selling point for businesses and individuals considering relocation. States without income tax often tout this advantage as a way to attract business, entrepreneurs, and high-income earners, potentially stimulating economic growth and job creation within their borders. However, other factors such as infrastructure, quality of life, and business climate may also play significant roles in decisions about relocation or investment. Weird thing number 3. Who has the highest state income tax? Here's a shocker. California has one of the highest state income tax rates in the United States. Now, the article I found is a couple of years old, but it states California has a progressive income tax rate with a top marginal tax rate reaching 13.3 for individuals earning over $1 million a year. This is California's high income tax rates that contribute significantly to its overall tax revenue and fund various state programs and services. Next up, New York. New York is another state known for its high state income tax rates, particularly high income earners. The state has a progressive income tax system with rates ranging from 4% to 10.9%, depending on income level and filing status. New York City residents also pay an additional local income tax on top of state income tax. Now, Hawaii has one of the highest state income tax rates in the nation, with a progressive tax rate system ranging from 1.4% to 11%. The top marginal tax rate applies to individuals earning over $200,000 per year. Hawaii's income tax revenue contributes to funding various state services and initiatives, including education, healthcare, and infrastructure projects. Weird thing number 2, income tax protests. One of the earliest and most significant tax protests in U.S. history was the Whiskey Rebellion. In 1791, the newly formed federal government under President George Washington imposed a tax on distilled spirits, particularly whiskey. The tax was highly unpopular among farmers and distillers in western Pennsylvania who relied on whiskey production as their main source of income. The rebellion culminated in armed resistance against tax collectors and federal troops sent to enforce the tax. President Washington ultimately led a militia force to suppress the rebellion, demonstrating the federal government's authority to enforce tax laws. Over the years, various grassroots movements and organizations have organized protests on Tax Day, April 15th, to express discontent with the U.S. tax system and government spending. These protests often focus on issues such as tax rates, government waste, and perceived injustices in the tax code. While Tax Day protests have occurred sporadically throughout U.S. history, they gained significant attention in the late 20th and early 21st centuries, particularly with the rise of social media and online activism. The Tea Party movement, which emerged in the late 2000s in response to government spending, taxation, and perceived overreach, organized numerous protests across the country. The movement's name was inspired by the historical Boston Tea Party protest against British taxation without representation. Tea Party protests often focused on reducing taxes, government debt, and the size of the government. While the movement was decentralized and included a diverse range of activists and organizations, it exerted significant influence on American politics, particularly within the Republican Party during the early years of the Obama administration. And finally, weird thing number 1, income tax scandals. One of the most infamous political scandals in U.S. history, the Teapot Dome scandal, involved the illegal leasing of federal oil reserves by the administration of President Warren G. Harding. Albert Fall, the Secretary of the Interior, accepted bribes from oil companies in exchange for granting them exclusive rights to drill on federally owned land, including the Teapot Dome oil field in Wyoming. While the scandal primarily revolved around corruption related to the oil industry, it also led to a scrutiny of Fall's personal finances, including allegations of massive tax evasion. Fall was eventually convicted of accepting bribes and became the first U.S. cabinet member to be imprisoned for crimes committed while in office. In 2008, Congressman Charlie Rangel, a Democrat from New York and the chairman of the powerful House Ways and Means Committee, became embroiled in a scandal involving ethics violations related to his personal finances and taxes. The House Ethics Committee launched an investigation into allegations that Rangel failed to report rental income from a vacation property in the Dominican Republic, improperly solicited donations for a public policy center named in his honor, and fails to pay income taxes on rental income from a villa in the Caribbean. In 2010, Rangel was found guilty of multiple ethics violations, including failing to report rental income and improperly using congressional letterhead to solicit donations. He was censured by the House of Representatives, marking one of the most severe forms of disciplinary action against a member of Congress. In 2009, former Senator Tom Daschle, a Democrat from South Dakota, withdrew his nomination to serve as Secretary of Health and Human Services in the Obama administration following revelations about unpaid taxes. Daschle faced criticism after it was revealed that he had failed to report and pay taxes on over $140,000 in income related to consulting work and the use of a car and driver provided by a private equity firm. While Daschle ultimately paid the back taxes and penalties owed, the controversy tarnished his reputation and led to his withdrawal from consideration for the cabinet position. Well, that's it for today's episode. I hope you liked it. I hope it pissed you off a little bit. Please like, subscribe, share the crap out of this video as a form of protest. Leave any opinions down in the comments. And today's word is corruption. Put that down in the comments just to stick it to the man. Take care and have a great day.